let's dive right into this explainer. Taking out a loan is often a massive life milestone, whether you're finally buying your dream home or securing the working capital to take your business to the next level. But what happens when that dream turns into a financial trap? Today, we are going to point-wise break down and clarify the most common mistakes borrowers make when dealing with banks and show you exactly how to avoid these pitfalls to ensure your long-term financial stability.
We really need to shatter the illusion that getting your loan approved is the finish line. It's actually just the starting line of a highly regulated, pretty complex relationship. So why do so many well-meaning borrowers end up in stressful legal battles with their banks? It usually isn't because of malicious intent. You don't take out a loan wanting to default. It's almost always due to small, entirely preventable mistakes, like misplacing a document or ignoring a seemingly automated email, that just snowball over time because of a lack of awareness about how the banking machine actually works. Here is our roadmap for today. 1. The banking relationship reality. 2. Paperwork and borrowing limits. 3. Discipline and daily compliance. 4. Navigating financial stress. 5. The partnership mindset. And finally, 6. A general information disclaimer. Let's hit Section 1. The banking relationship reality. Setting the stage. To really ground our explainer in reality, let's look at a quote from Ashok Kakkar, a banker with over 40 years of experience. He points out that banks operate through written records, regulatory compliance, and risk management systems. Think about it this way. That friendly branch manager you negotiated with today over a cup of tea might be transferred to another city tomorrow. If your agreement with them isn't formally logged into the bank's digital system, it literally does not exist. It doesn't matter what they promised you verbally. Moving right along to Section 2, Paperwork and Borrowing Limits, the setup phase. It's honestly fascinating how early the seeds of a banking dispute are planted. Borrowers constantly put their trust in a verbal assurance. But look at this comparison. Verbal promises are totally unauditable, they disappear the second there are staff changes, and they hold absolutely zero legal weight. Written records, on the flip side, are legally binding, they protect both parties, and they are essential for audits. If you negotiate a perk, a waiver, or specific term, you absolutely must get it in writing. I completely understand it is super tempting to just rush and sign a 50-page document without reading it, especially when you are eager to get those funds. But hastily accepting standard terms hides severe costs. You have to read before signing and beware of hidden traps. Things like penal interest, punishing charges that can crush your cash flow, or loan recall clauses, which actually allow the bank to demand full repayment of your entire loan out of nowhere. And cross-collateralization, a tricky mechanism where defaulting on one loan might let the bank seize the collateral you put up for a completely different, perfectly performing loan. So, how do you avoid overborrowing? By adhering to strict, prudent limits, even if the bank happily offers you more. Keep your debt-to-income ratio under 40%. You can easily check this with EMI calculators. Always keep a 20 to 30% buffer for unpredictable life risks, testing that through scenario planning. And for businesses, your DSCR, or debt service coverage ratio, should be at least 1.25. Simply put, for every dollar of debt, your business needs to generate $1.25 of cash flow. Let the cold, hard math dictate your limits, not excitement. Okay, Section 3, Discipline and Daily Compliance, Ongoing Management. Once the funds hit your account, discipline becomes everything. You have these required routine submissions, KYC updates via CKYC, annual financial statements, regular stock statements, and insurance renewals. You might think, these are just annoying administrative chores. But from a bank's perspective, delaying these basic submissions is a massive red flag. Treating these documents casually can literally result in your accounts being instantly frozen. The good news is you can automate this discipline. Step 1, set up ECS for automatic EMIs so you literally never miss a date. Step 2, maintain completely separate accounts for your loan funds. Diverting business funds for personal use is a major compliance violation. Step 3, actually review your bank statements monthly. A single bounce check might seem like a tiny oversight to you, but to the bank's automated systems, it triggers immediate scrutiny. And whatever you do, do not ignore your CIBIL score. Assuming the bank will flawlessly manage your credit history is a really costly mistake. System errors happen all the time. Unmonitored reporting errors can drag your score down, which leads to massive hikes in your future interest rates. Be proactive, check your report thoroughly every single year, and dispute any inaccuracies immediately. Let's pivot to Section 4, Navigating Financial Stress, Crisis Management.
let's talk about what happens when money gets tight. Before you casually sign a personal guarantee to secure funding for your business, you have to understand the gravity of it. A personal guarantee is a binding agreement that creates direct legal liability on your personal assets, completely independent of the business. You are fully exposed under the Insolvency and Bankruptcy Code, or IBC. This means the bank can come after your personal family home and life savings. You are putting your family's future on the line, so never treat it as a mere formality. When a true crisis hits, silence is your absolute worst enemy. Check out this timeline. You miss an EMI. Let's say you ignore the warnings between days 7 and 30 out of sheer embarrassment. By 90 days, your loan hits NPA, or non-performing asset status. Post 90 days, the bank is basically forced to initiate Sarfasi legal action, empowering them to auction off your collateral without even needing extensive court intervention. Ignoring those early warnings drastically accelerates this total nightmare. So instead of hiding, you need a proactive crisis protocol. Contact your bank within 7 days of anticipating a cash flow issue. Walk in there and propose solutions yourself, like a loan restructuring or temporary moratoriums. And crucially, document your specific hardships in writing. Banks actually have strict frameworks designed to help stressed borrowers, but they can only legally deploy those safety nets if you speak up early and get everything clearly on the record. All right, Section 5, the partnership mindset, resolving the tension. To really master this, we need a fundamental shift in how we view the bank. Look at the difference between treating them as an adversary versus a stakeholder. If they are an adversary, you are met with suspicion, confrontation, and blocked negotiations. It's lose-lose. But as a stakeholder, you get transparency, shared updates, and mutual resolutions. Remember, the bank's ultimate goal is simply to safely recover their depositors' funds, not to gleefully ruin your life. So, I want to leave you with a provocative question to challenge how you manage your obligations going forward. Are you treating your bank as an opponent to be outsmarted, or as your most powerful financial partner? A well-managed loan should powerfully fuel your growth, not become a lifelong burden. Taking small, deliberate precautions today will absolutely save you from massive headaches tomorrow. Finally, Section 6, General Information Disclaimer. Please remember that this explainer is strictly for general informational purposes only and does not constitute legal, financial, or professional advice. Always consult a qualified professional, like a lawyer or certified financial planner, or reach out directly to your bank for specific guidance. Thanks so much for joining me to untangle all this. Here's to all of us building way smarter financial partnerships in the future.